Jurrien, I know it's early days, but we're 10 for 10 on bottom line beats this morning. You make the point that what we get in Q2 could come at the expense of Q3 guidance?
Well, yes, and this is what happened in the first quarter, right? So if you look at the progression of earnings estimates from the street, expressed as a growth rate, the bottom was supposed to happen in Q1, and then this big V-shaped recovery. And what ended up happening is that every time a company beat in Q1, and the end result was about 400 basis points better than the initial expectation, that beat came at the expense of lower guidance to Q2 or Q3. And, earnings season for the second quarter is only just underway, of course. Last week, only like 22 companies reported. But we saw the number go from -3 to minus 2.2, so already a big pickup. But again, it's coming at the expense of Q3. And so, this kind of describes the tension in the market, right? If it's always about growth and rates, and the Fed is now, coming to the rescue, if you will, with lower rates, you can afford some weaker growth because the denominator of the discounted cash flow model is kind of helping you out. But we do need to see that recovery at some point that is expected in the second half of the year into 2020, or else the market is a little bit too expensive at 17.3 times forward earnings.
Yeah. Jeff, how about you? Comment on the earnings that we've gotten, at least on this day. And then, are you unnerved by top line, which is not, at least right now, as good as what we're seeing on the bottom line results?
Yeah, the top line's weak as well. I think financials matter a lot, even though we're seeing manufacturing indicators like the global PMI continuing to slide for 14 months in a row, which says bad things about the top line. But if we look at the biggest sector by earnings, that's financials here in the U.S. and Europe and Japan. And that doesn't look bright if we're at the start of a Fed rate cutting cycle. I know some capital market revenue was better, but certainly net interest income headed down. We don't know all the details behind the cuts, but maybe more to come if we are, in fact, on the start of an easing cycle. And that means those forecasts that Jurrien just talked about, the fourth quarter of this year, strong single-digit numbers expected for the U.S. for the S&P 500, but double-digit numbers in Europe and Japan. Those are at high risk of disappointment. And with valuations having crept higher all year on relatively, zero earnings growth, let's face it, they're really at risk in the second half. So look for a more difficult second half, particularly from an earnings perspective.
Jeff, we keep hearing about this issue of the ongoing trade tensions with China pressuring the outlook. How important is it that the United States and China, and then on to Europe, that these trade deals get done?
This is really important from a sentiment perspective. We're not seeing too much show up in the economic data, but if you take a look at what's happening in terms of capital expenditures, it's really had an impact. The CFO survey that came out last month from CFO Magazine showing most CFOs around the world are expecting a recession to start sometime next year. A lot of that tied to the trade concerns. We're seeing very little CapEx coming forward, and industrial production is slumped as well. So that's a big part of the backdrop here, the paralyzation of business decision making in an environment where the trade picture between the two largest trading nations is unknown.
Hey, Jurrien, sounds like you think a proactive Fed, as in your words, could be just what we need to extend the business cycle further and get the market out of this 18-month-long holding pattern. If the Fed speakers are going to pivot on expectations, they don't have much time.
No, exactly. I mean, at this point, I think a 25 basis point cut at the end of this month is pretty much baked in. I mean, they certainly would have walked the market back from that expectations if it wasn't going to happen. So I think the Fed is in, and if the Fed, I think the market is expecting the Fed to basically extend the cycle like it did in 95 or 98. I think that's the assumption. It may be a wrong assumption, but I think that's the assumption, and that's why the market is trading as well as it is despite pretty weak earnings growth, and why it has pushed up the multiple, because the market is going to kind of assume that it's all going to be better in 2020, and then the Fed has extended this cycle. I mean, remember, the Fed's about to cut rates while the output gap is positive and growing. Credit spreads are pretty average. Financial conditions are back to the easy levels from last October. So it's a pretty rare backdrop where the Fed is easing really without any clear and present danger, I guess, to the economy and to the market.
Right. Jeff, I assume you'd prefer to see one and done rather than a protracted cycle of cuts, right?
Well, at this point, yeah, it doesn't seem like in the U.S. there's a whole lot of need for the Fed to cut. But look, in Europe, it'll be very interesting to see what the ECB or even the Bank of Japan does. They're looking towards more stimulus. We obviously know things are slowing down globally. Their stimulus might look more like QE than rate cuts. That actually could be good for financials earnings, whereas rate cuts may be a drag. So maybe look for a bifurcation in the results or the guidance we hear from some of the European financials versus those in the U.S. over the coming weeks.